Good evening and welcome to the March 2016 Richardson Law Office's Legal Hangout. This month we're going to be talking about means testing. Now let me tell you about what means testing is and why we're talking about it this month. One of the myths out there, and as a result a question I get asked a lot as a bankruptcy attorney by people that talk to me in my office, is I think I make too much money to file bankruptcy. I have too big an income, so I can't file. That's not necessarily true. Okay, there is an analysis of your income to determine which bankruptcy is appropriate for you. But bankruptcy is not taken off the table or removed as an option simply because of your income. So that's not something that you should automatically assume. Don't sit there and think, oh, I can't file bankruptcy, I make too much money. No. Talk to a bankruptcy professional. Talk to a bankruptcy attorney. And we can go over your situation and see what your income situation is and whether that even presents a problem in filing a Chapter 7 versus a Chapter 13. Now, what do I mean by a Chapter 7 and a Chapter 13? Well, a quick definition is a Chapter 7 is a quick and dirty way to, as I put it, hit the financial reset button. Start all over. It's a do-over, a restart. It wipes out most all types of debts. There are some exceptions, but credit card debt, medical bills, most of the debt that people have, it gets wiped out in a bankruptcy. In most cases, because a Chapter 7, strictly speaking, is a liquidation bankruptcy, a trustee looks to see if there's any money that can be made from liquidating your assets to pay your debts. In probably 95 out of 100 cases that doesn't happen, and I'll get into that a little bit later, but it's called liquidation bankruptcy, and you're pretty much in and out. Most people don't have assets at risk. They file bankruptcy, 3 to 4 months later, they get their discharge and it's over. And obviously, those people, the vast majority of people simply don't have the income by the time they pay their expenses to file bankruptcy, to pay their debts, so that the debt is wiped out and they move on. A Chapter 13 is a debt repayment plan, most often used in instances where there's a home in default, in foreclosure, and you try to save the home and you have to get caught up on the mortgage, and Chapter 13 can allow you to do that. Now, there are other reasons to file Chapter 13, but that's the most common one. So income comes into play in means testing in which of the two bankruptcies you file. Now, for many years, from the late 1990s into the new millennium, there's a lot of lobbying in Congress and a lot of talk about whether people were abusing the bankruptcy system by filing when they really could pay at least some of their debts back. They went for the quick and dirty option when they could have paid something. And ultimately, in 2005, more specifically on October 17th of 2005, when the law changed, Congress added an element called means testing. And the purpose of means testing is to determine whether you have the means, the financial means, the income means, to pay at least a portion of your debt in a Chapter 13 bankruptcy. And the idea was to push upper income people into a Chapter 13 repayment plan, bar them from filing a Chapter 7, or force them into a 13 if they file a 7. So that's what means testing is. Do you have the means? Do you have the financial means or wherewithal to pay at least a portion of your debt back over 5 years in a Chapter 13? Well, how is that done? As I stated, it's upper income people that are trying to force into bankruptcy. Well, that is determined by looking at the median income for your state based on census data, which is then adjusted periodically for inflation. The median income in your state for your family size, family of 1, 2, 3, 4, 5, however many people in your family. And the median, as opposed to the mean being an average, the median means that that's the halfway point. In other words, half of the people in the state make more than that median and half make under it. So means testing is a way of determining whether you're above or below the median. If you're below the median, great. If you're above the median, it can cause some complications. There's a more involved means test, which I'll step you through in a moment. But that's that line that gets drawn, is the median income, and it's determined state by state. So that median income is also rather artificially determined. There's a look back of 6 months prior to your date of filing bankruptcy. So this is March. Let's say you filed today, March 24th. Well, that means testing look back would be from September 1st through February 29th. That's 6 months. And what was your gross income during that period of time? Now, obviously, your gross income is not what you actually take home. That's the net, because there are all sorts of deductions, but it starts with the gross. So you add up all the gross income from every source. There are some exceptions. For example, Social Security benefits are not part of means testing. Social Security retirement, Social Security disability. And there are some other income benefits and exceptions to means testing, but for the most part, any source of income, business income, wages, rental income from rental properties, any income you have in that 6 month period, all gets added up, doubled, and that's your annual income. And then that's compared for your family size to the median in your state. Here in New Jersey, obviously state of New Jersey. And if you're below that in that analysis, then no problem. You can continue on, file a Chapter 7. If you're above the median, then you have to take the next step, which is go through and take some deductions from that income, for example, taxes, and I'll get to that in a moment, to determine whether after all the deductions from that gross income, whether there's a sufficient amount of money left over to pay your debts or pay a portion of your debts over 5 years. So let's look at the numbers. Now, as I said, these get adjusted periodically for inflation, and that's about to happen April 1st. To everyone on my mailing list that has been looking at bankruptcy, I sent out an alert recently to talk about the changes. But basically, here they are. Right now, as of March 24th, if you have a household of one, now that's not necessarily one wage earner, or when talking about the household size, they're not all wage earners. It's everybody in the household, whether they have an income stream or not. So one person is $61,274 a year. That's the median. If you're below that, as calculated in that 6 month window and then doubled, then you're fine. For two people, it's $73,099. 3 people, $89,983. 4 people, $110,956, and for every person over 4, it was an additional $8,100. Now, as of April 1st, they're changing, and not by a lot, by very little, but it is the median is going up, which is a good sign for most people that are making below that, because it's more likely you qualify outright for a Chapter 7. One person goes from $61,274 to $61,347. 2 people from $73,099 to $73,186. And these numbers are on my website. I'll provide the link so you can take a look at them in detail. 3 people, $90,090. 4 people, $111,088. And for each person over 4, instead of an additional $8,100, it's an additional $8,400. So you start getting into a family larger than 4, the increase is even more dramatic. So over or under, or you're over it or under it. Now, timing can be important. So, for example, if you're in sales, or if you where you get bonuses per quarter, or some other, you get an annual bonus, for example, you don't want that bonus to be in that 6 month period of time, because that bonus is then going to get doubled, because they take the 6 month income, double to get a 12 month income to compare to the annual income figures for means testing. So you sometimes you have to move that window a little bit so it's more representative of what your annual income is. If you're a teacher, for example, well, you don't work 12 months out of the year. You work 10 out of 12 months. So for July and August, you don't work at all. You don't have income at all. Some school districts average it out and pay through the summer. Some of them make deductions during the year and then give you the money during the summer. But to a great extent, as you can see, if you're a teacher and you want to pass means testing, you want to have July and August in your 6-month window. So that 6-month window and where it is can be important. If you are, because there are more than 4 weeks in a month, 2 months in a year, you will get an extra paycheck. Well, you don't want both of those months in the 6-month window, and sometimes that can happen. So where that window is can be important. So again, if you fall below that median, you're fine. If you're above that median, then we have to do a little bit more calculations, and we have to start looking at the deductions from that. Now, those deductions, Congress didn't come up with the numbers on their own. They basically said, well, the IRS already does this. If you've ever had to negotiate with the IRS for payment of a tax debt, there's something called an offer in compromise. And the IRS has some standardized numbers when you look at, all right, this is how much we make, this is our salary, and this is how much it costs us to live. And this is why we can't pay the tax debt all at once, because we don't have that kind of money. And the IRS was, well, no, wait a minute. Now, just because that's what you spend doesn't mean that that's a reasonable amount for those expenses. And we have statistical data on living expenses depending upon where you are in the country, that sort of thing. Some of them. So they use the IRS procedures in those numbers for expenses and means testing. Now, some of the expenses are standardized. Some of them are whatever your numbers are, is what you plug in. And then some of those individualized numbers can be capped, like educational expenses for a child. But, so naturally, if you're above the median, then we have to go on to step 2 and start deducting expenses. So first thing you deduct, taxes. You had to pay taxes. There were tax withholding on that gross income. So that has to come out. And that's whatever it is. Other individualized expenses are insurance, what you pay for health insurance, disability insurance, life insurance, whether it's a payroll deduction or a monthly expense that you pay outside of your pay. If you have a health savings account with your employer, if money is set aside for that, that's a deduction in means testing. Educational costs. It can be private tuition for a private school for a child under 18. It could just be books, school materials, things like that. Now, there is a cap on that per child. So although it's an individualized expense, it is capped. So you have to look at those. Child care expenses, daycare, latchkey programs, things like that that are required because you're working and your child comes home from school or finishes school before you're home from work. So those expenses are deductible. Charitable giving. Really, as long as you have the paperwork to prove that you actually made those charitable donations to an approved 501c3 charity, then it's deductible in means testing. It gets deductible out. So if you're a very generous charitable person, that all comes out. Mandatory contributions to pensions. Now, this is a sort of a catch-22 between a Chapter 7 and a Chapter 13. In a Chapter 7, you can only deduct a pension contribution if that pension contribution is required for the job. So, for example, if you have a job through a union hall, and only union members can get these jobs, and every member of the union has to contribute to this pension. Well, then that's a mandatory pension, and you have to deduct that. You can deduct that from your income in means testing. Also, union dues for that union, it can be deducted as well. But if it's voluntary, if it's just your employer has a 401k program, a pension program plan, and you've been contributing to it and it's voluntary, in a Chapter 7, you cannot deduct that in means testing. If you've borrowed against your pension, you cannot use that pension loan payment as a payroll deduction in means testing. Now the catch-22 comes in that, okay, let's say means testing says you have to be in a Chapter 13. Well, you go into a Chapter 13, and Chapter 13 means testing analysis allows for the deduction of voluntary pension contributions and pension loans. So sometimes you can actually be in a situation where you have money for a plan if you look at it under Chapter 7, but if you went into Chapter 13, you don't have the money because you're making those pension contributions and paying that pension loan. Personally, I don't think Congress thought this one through. It's a somewhat catch-22, but that's one example of why the law often doesn't make sense. But that's that deduction. Some expenses are not whatever you spend, but whatever the government and the IRS in this case, Bankruptcy Court Trustee's Office, thinks you should be spending. Now, that means food and clothing. That's a national expense. This is how much we think your family size should be spending on food and clothing. Whatever it is whatever it is. And that gets deducted. Sometimes you can justify an increase in that. You can play with it a little bit, but that's really on a case-by-case basis. It's a national figure that gets deducted. Now, these numbers also get adjusted. I mentioned that the median incomes get adjusted, but these deductions do as well periodically with inflation. Healthcare costs. Now, if you're under 65, it's $60 per month per person. If you have a household members over 65, it's $144. Is what it is. Okay. If you spend more than that, you may well be able to work that into your means testing analysis, but that's the standardized deduction for medical expenses. Housing and utilities. That's more on a county level. So look and say, all right, living here in Gloucester County where my offices are in Woodbury, what are the housing and utility expenses in Gloucester County? And that gets plugged in. Transportation. Now this is sticky. It can be, especially with what we pay for auto insurance here in the Garden State. There are two deductions that you can have. Let's say you have two cars, and one of them you own outright, and the other one you are making monthly payments on. Well, for each vehicle, means testing considers on a regional basis here in the Northeast Philadelphia area, where my office is, there are numbers for cost of ownership and cost of operation. Now, cost of operation is what you are spending on gasoline, maintenance of the vehicle, things like that. And then there's cost of ownership. Now, if you have that car that you own outright, you can get cost of operation for that vehicle, but you cannot get cost of ownership. There has to be some sort of monthly payment, some sort of loan that you have on that vehicle for you to be able to deduct in means testing cost of ownership. So if you have a car loan, you can deduct both cost of ownership and cost of operation. If you own it outright, it's just cost of operation. Now, what happens when your car payment is higher than what the cost of ownership is? Well, then you get the cost of ownership. You get the monthly payment to the bank. So let's say the cost of ownership is $250, but your car payment is $350. Well, then you don't use the cost of ownership figure in means testing. You use your actual car payment. Now, that car payment is not your regular car payment. Let's say you have 3 years left on the loan, 36 months. Well, you take that balance and you divide it by 60, not by 36. So that number, that payment actually goes down because it's calculated over the mandatory 60 months or 5-year Chapter 13 plan under means testing. So you have to be careful with that. If that car gets paid off before the end of a hypothetical 5-year Chapter 13 plan, then that car payment gets stretched out and gets lower, and you can't quite deduct as much. But at the very least, you can deduct whatever that cost of ownership figure is. Now, that also works for mortgages. I talked earlier about housing and utilities. You have a certain cost of housing, but if your mortgage payment is higher than that allowance, then you get your mortgage payment. But what if it's lower? What if your mortgage payment or car payment is lower? Well, they basically allow you, you still get the difference. So for example, if it's flipped, if your cost of ownership is $350 and your car payment is $250, then you will deduct a $100 cost of ownership, and then later in means testing deduct that $250 car payment or mortgage payment. So one way or the other, you get at least that allowance, if not more, if your actual payment's higher. So that's means testing. We go through, we deduct, and there's some other nitty-gritty stuff that are on a case-by-case basis, but you get the idea of how that is done. So you deduct out all of those expenses, and then you look at what's left. And if it's a negative number, well, you obviously don't have the means to pay any creditors because you are deficit spending under means testing. If you make a minimal amount of money, very little, then even though you have positive cash flow, it really wouldn't make any difference to creditors, wouldn't make it for a meaningful dividend on debt, and you'd still qualify. But if you can make a significant contribution, a significant payment on your debt over 5 years, again, depending on what your debt load is, under means testing, if you can't quite close that gap, get the curtains to close all the way, then you can run into a problem, and you might not be able to file a Chapter 7. You may have to file a Chapter 13, and that can create a difficult situation. I will say that in most instances, when I'm looking at people for a Chapter 7, it's seldom that I can't close the curtain all the way. Usually it meets up and it's fine. Every once in a while, they end up in a catch-22 where they've got to file a Chapter 13. Now, in a Chapter 13, that analysis, if you file a Chapter 13 and your income is above the median, then you must propose a 5-year repayment plan unless you can pay 100% of your debt in less than 5 years. So it's a presumptive period of 5 years. And then means testing can determine how much is paid to your creditors. That is what determines what the plan payment is. So means testing can be very important when it comes to whether you qualify for a Chapter 7 or if you're in a Chapter 13, what your monthly payment's going to be. Now, I know I've thrown a lot at you. There is some material on my website that talks about means testing. You can take a look at that. Take a look at some of the numbers that are there. If you live in the Gloucester County area down here in South Jersey, I'd be happy. Just give me a call. I'd be happy to sit down with you. I may not be able to do a detailed means testing analysis of your situation. That's often can't be done in an initial consultation, but at least get some idea of where you stand and what you might be facing with regard to means testing. In other words, do you really and truly make too much to file a Chapter 7? And that's what we're talking about here. So that's means testing. Oftentimes these numbers get adjusted more than once a year. They were adjusted last November, November 1st, and then they adjusted again April 1st. So these numbers do change. Sometimes they go down. Sometimes the median incomes go down. And there are people rushing to file before the numbers change. But this time they've gone up, not by a lot, but they've gone up. So that's that. So that's our topic for this month. But I do have a bonus, okay, for those of you who tuned in or are watching later. In addition to means testing and talk about something else, because there are other numbers that change after April 1st. As I mentioned before, a Chapter 7 is a liquidation bankruptcy, and they look to see whether you own any assets that, if sold, could raise enough money to pay your debt. But most people don't, because there are certain exemptions that will allow you to keep assets up to a certain value. That is what oftentimes keeps the trustee from selling your home. You get to keep your home because you can exempt a certain amount of home equity. Well, those exemption numbers, some of them are unlimited. You get to exempt all of it. Others have caps on them. Well, those caps adjust once every 3 years on April 1st. The last time they were adjusted was April 1st, 2013. So guess what? April 1st, 2016, next Friday, they go up again. Again, not by a lot, but they do go up. And it can make a difference between filing a 7 and getting to keep that asset or having the trustee sell it. So just to give you an idea, we have, for example, on your residence. Now, this is for each individual debtor. So, for example, if you have, if you are a single person, you own a home, then you, or whatever the asset is, you can take your maximum, up to your maximum exemption for that particular asset. But if you own it jointly with a spouse, then, and that spouse is filing bankruptcy, and then that spouse also gets an exemption. So, on your principal residence, on the real estate or a piece of personal property like a mobile home, if that's your principal residence, then you can exempt, it was $22,975 for the debtor or for husband and wife or both spouses in a joint bankruptcy. Each of them could exempt $22,975 or almost $46,000 together of net equity. That's going up from $22,975 to $23,675. So that's going up as far as exempting home equity. Your car, your sedan, your SUV, whatever, you can exempt currently $33,675. That's going up to $3,775. And of course, you can really only exempt one vehicle. So husband and wife, it can make a difference as to who it's titled to, who owns it. So be careful. If you and your spouse each have a car, but they're both titled to one spouse, will apply, that one spouse can really only apply an exemption to one of those two vehicles. So it can make a difference in how it's titled. Household goods and furnishings and clothing. Now that is if it's an aggregate exemption, so it's the contents of your home, not each individual piece. If on an individual basis, any one item, as long as it has a sale value, a distressed sale value, which is what a trustee will be looking at, of no more than $575, then that's exempted. And you just put that into the aggregate exemption. If it goes above that exemption, you have to, in value, you have to itemize it. Well, that is going from $575 to $600. The overall aggregate exemption for household goods and furnishings, and again doubled for joint debtors, and along with clothing, goes from $12,250 per debtor to $12,625. And again, these numbers on my website, I'll provide the link. Furs and jewelry, your wedding ring, your diamond engagement ring, maybe your Apple Watch, your watch, or your whatever jewelry of value that you have. The exemption is going from $1,550 to $1,600. Tools of the trade. I've represented mechanics, carpenters, people that have specialized tools, things like that. Those can be exempted from it's going from $2,300 to $2,375. If you have a life insurance policy, a whole life insurance policy that builds value, has a cash surrender value, you can actually cash it in and get the money instead of the death benefit. That's going from $12,250 to $12,625. Again, not a lot, but it can make a difference in certain circumstances. Pain and suffering damages for personal injury actions are going up from $22,975. Then there's something else called a wild card exemption. And what that is, you've noticed up to this point, I've been talking about exemptions that are against a particular type of asset, your principal residence, car, jewelry, clothing. The wild card exemption can be applied to anything you want. and often apply to bank accounts and other liquid assets. And that's up to half of the unused homestead exemption. So if your home is upside down, you owe more than it's worth, and you don't have to use any of your exemptions for your principal residence, then you can each of you can use the maximum wildcard exemption to exempt whatever you want. And that's going from $11,500 to $11,850. Again, all these numbers are on my website. So consider that in whether or not you should file a 7 or whether your assets are protected. And in most instances, they are. So that's it for this month's Hangout, for our March 2016 Hangout on means testing in bankruptcy. Fascinating stuff. Next month, our April Hangout is going to be on April 28th at 5 p.m. And on April 18th, there are going to be some changes to New Jersey state law under expungements. So if you have some skeletons in that closet of yours, some minor convictions, an arrest record, things you'd like to clean up and get expunged, there have been some changes to the law that can make it easier and more straightforward. So I'm going to go over those changes to expungements next month on April 28th at 5 p.m. So be sure to tune in, and we will discuss that then. If you liked this episode, I'd appreciate it if you would hit that thumbs up button underneath the video. And if you are really enjoying our content, my content is presented on richardson.lawoffices.tv, our YouTube channel here. Please be sure to subscribe. As I said, I do these Hangouts every month, as well as releasing at least one video, informative video, every week on a different legal topic within my practice. Something in either bankruptcy, collection and credit, traffic tickets, DUI tickets, student loans, all sorts of stuff. So be sure to subscribe to get all the latest content. Other than that, we're getting warmer weather. We're into spring. And if you celebrate Easter, I wish you a happy Easter this Holy Week. We wish, if you celebrate Passover, happy Passover with your family. And I'll see you next month.